Hey everybody, so today I'm going to talk about why I think we're heading into a recession, what I'm looking at and what I'm doing. Be sure and wait till the end because you're going to love what I'm doing right now. So it should be no surprise. All you got to do is Google, which I did in just like 5 or 10 minutes. There's a ton of articles, there's a ton of opinions. These are from the New York Post, the New York Times, Fortune, Forbes, etc. You can see that a lot of people are watching this and looking at this right now, and so should you. So there's a lot of indicators that determine what a recession is. I broke it down into 3 things that I'm watching and also what I'm doing right now to be in front of this potential recession. But first, we got to talk about what is a recession. So in theory, what a recession is are jobs lost, people buying less, businesses are suffering. All of this is a vicious cycle which contributes to 2 quarters of consecutive GDP or gross domestic product. That is essentially the United States income and expense statement. These are just 2 examples of 2 consecutive quarters showing that there was a recession, as we certainly had during the pandemic as represented by the numbers. But for purposes of this video, there's a couple things here on this chart that I really wanted to highlight. The first one was an inverted yield curve. For those of you who are not economists, just stick with me because I'm not either, but I'm trying to figure this out too because it's a leading indicator and very important. The next one is a 3-month drop in the unemployment rate, which of course is debatable depending on how it's reported. An index of the leading economic indicators, and there's a lot of these that you need to pay attention to. I broke down just a few. Assets substantially drop in price. In addition, severe stock market declines may precede recessions. So, as we know, the Fed just increased interest rates, and of course, that may have significant consequences on the stock market. As you dive into this even more, you can see that the decline in a stock market is even more of an indicator of the last 10 recessions that we've had have been followed by stock market declines. Now let's get into the 3 things that I'm watching really closely. The first one are other countries. There's a lot of other countries in recessions, and we're not really talking about this. Number 2 is decline in economic activity. Now, these are things like low wage growth and high inflation. And we have, of course, the supply chain issues resulting in more higher prices in the future. And then 3, the yield curve, which my economics professor in college would be really happy that I'm going to talk about. So number 1, let's talk about the global recession. So obviously the pandemic and COVID-19 sent almost all of the G20 countries into a recession. This statement is actually about 2 years old, and the reason why I included it because it had these forecasts. And if you Google right now, is China in a recession? The answer is yes. Just go take a look for yourself. And as you can see, a lot of these things did not happen. A lot of countries are still in global recessions. And as you guys haven't figured it out by now, we are a world economy. We buy and trade with the world. Almost everything that you buy is from China, Taiwan, Vietnam, etc. It's important to watch these other countries and see how all this is going to play out as it relates to you here at home. Number 2, the decline in the economy. And a lot of you are going to go, well, housing prices are up. How can that be? Well, I'm going to talk to you about some other things. Number 1, the Federal Reserve approved the first interest rate hike in more than 3 years, and they expect 6 more ahead. They did a 1/4 point today, which is going to affect consumption. It's going to affect people buying things on their credit cards. It's going to affect auto purchases. It's going to affect you buying a TV or a home or whatever it might be. Anything that's finance is going to be impacted here. This, of course, is going to slow things down, which is exactly what a recession is. The second thing I want to talk about is this inflation here. And as you can see, the annual inflation rate was 7.9% in February of 2022. That means that if you had cash in the bank as a saver and you're making 1%, that means that you're going backwards 6.9% on the purchasing power of your dollars. That means that you are getting poorer and poorer as this inflation continues to hit. So you need to make a decision as to what you're going to do if this continues. As you can see from this, this is the highest inflation in 40 years. And what they're saying here is the surge in energy costs due to the war in the Ukraine is still to come. What that means is they're telling you that they expect higher inflation in the future. Originally, they thought that inflation was going to peak in March of 2022, but the recent developments in Europe, coupled with the ongoing supply constraints, strong demand, labor shortage will likely maintain inflation elevated for longer. This is the Bureau of Labor Statistics right off of their website. Now let's talk about employment. I know if you just go online, it all looks rosy, but let me show you a couple things that maybe you haven't looked at. The earliest signs of recession show up in the small employers around the country. And as you can see from here, in February, 4.2 million persons reported that they had been unable to work because their employer closed or lost their business due to the pandemic. That is, they did not work at all. The reason this is important, this is actually down from 6 million the previous month. So when somebody's reporting that it's actually improving, this is what they're talking about. It's going from 6 million to 4.2 million, which is still bad. These are real hardworking people that are now being sent home and are forced to either live off the system or go find some other work, and they're not being reported correctly. As you can see here, this is a leading indicator of businesses that are really getting hurt from the pandemic. This is 2 years later. The headline number for unemployment, for the people that are actually seeking employment, those are the numbers that you actually see in the newspaper. But when you dig a little bit deeper, you see that there's millions and millions of people affected right here, and they're being displaced, and some aren't even being counted in the overall number. Therefore, I believe that these businesses that are having to close or have lost some business due to the pandemic are leading indicators of a potential recession as more and more workers get displaced. Now, third, why the yield curve is important. And as I said, my economics professor will be super happy because I got a C in that class. So first, let's take a look at the yield curve and what's normal and what's inverted. What's most important for you right now is that we are in an inverted yield curve scenario, which means it is not normal. So what exactly does that mean? Inverted yield curves are rare and generally reflect periods of significant economic slowdown, which we are definitely seeing, and we talked about earlier, and often recession. And here's why. Investors accept lower long-term yields because they believe economic conditions may deteriorate further and that short-term yields may be lowered to stimulate economic activity. So in other words, they don't believe in the long game. The most alarming thing, of course, is the yield curve has inverted before every U.S. recession since 1955, suggesting to some investors that an economic downturn is coming. So now we're going to talk about the frog in the pot, because at this point, I'm sure you guys are commenting and saying, housing's up, blah, 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 things are good, I got all kinds of cash, I got all kinds of equity in my home, et cetera, et cetera, et cetera. The boiling frog is often used as a metaphor, of course, for the inability of people to react to significant changes that occur gradually. All of us are the frogs, and the water is the U.S. economy. Everything that hits, think of it as 1 degree higher in temperature. So while we're in here now and it feels good, as it slowly gets hotter and hotter and hotter, we don't notice. So things like higher interest rates, things like lower wage growth, things like supply chain issues. Now, there's 3 types of frogs. Frog number 1 is the one that doesn't see, hear, or think, or know about anything that's going on today at all. Frog number 2 is the one that just sits in here and sweats, doesn't know what to do, full of indecision, and just tries to use logic but doesn't make a move. Frog number 3, that's the frog that's gonna jump out of the pot before it boils and tries to convince frog number 1 and frog number 2 of everything that's going on. That's what I'm trying to do for you right now. Lastly, what am I doing now? Item number 1, make sure that you get out of cash. Now, obviously, you're going to need some cash, but if you're saving, you're getting killed right now, and it sure looks like next year's not going to be any better. Number 2, get into fixed rate debt. Fixed rate debt is important because you can lock that rate in right now today with other people's money in the form of debt. So all the real estate that you buy, all the real estate that you own, or anything that you have, if you fix it today, you're actually hedging inflation and any uncertainty in the future. And don't forget one small detail. The Fed told you that they're going to raise rates again in the next 6 sessions. Inflation hedge your dollars. So how do you hedge the dollar? you get into real assets. And all you got to do is Google what are real assets. And as you guys know, I'm heavy in real estate, but I'm also heavy in silver. I'm heavy in gold. I'm heavy in commodities, things that rise during inflationary periods. That's where you want to be with your cash. And fourth, have liquidity outside of the banks. So as you guys know, it's always important to have some money outside of the banks just in case you need it, in the form of cash, even though I said not to hold it, in the form of gold, in the form of silver or diamonds or anything else that you might need outside of the banks. It's very important that you don't have all your eggs in one basket inside of the banks, because we don't know where all this is heading. So thanks again, guys. If you find any value in this, please hit the subscribe button, the like button. It really means a lot to me.